With us coming up on almost a year of being on lockdown, I decided to revisit some of the stocks that actually did pretty well throughout this situation. And we can't really have that discussion without taking a look at Zoom. But that started to raise the question for me. Was 2020 just a one-off year for Zoom, or are they able to sustain the growth that they experienced during 2020 moving forward? Well, that's what we're going to talk about today. Hey everyone, and thanks for joining me today. My name is Matt, and as I mentioned in the intro, today we're going to be taking a look at Zoom stock. Now before we do that, I just need to say, not advice, I'm taking this advice, you need advice, speak to a financial advisor. They'll be able to assist you, but this is just for your entertainment purposes only. Also, bear in mind that if you like this video, it's still a 5-cent donation for charity, and if you subscribe, that's a 10-cent donation for charity, so do what you please. Now, I'm sure everybody at this point is familiar with Zoom. It's basically become a verb. But just in case, Zoom is that video communication software that everybody was using during 2020 to see each other and still interact with your friends and family. Now, at the start of 2020, Zoom was trading at around $66 a share, and at one point around October of 2020, Zoom hit $500 a share. Now, since then, their stock price has scaled back a little bit, and that made me think that maybe we have a buying opportunity here, and I want to explore the stock a little bit further. So, to start off with, as always, we're going to start with taking a look at Zoom's numbers. Now, as always, I do have a few kind of caveats or side notes that I wanted to mention about the numbers before we dive right into them. And the first thing is, I tried to use more forward-looking metrics, and actually I only used one, but I didn't do like revenue growth year over year or EBITDA growth year over year, because 2020 was definitely a different kind of year than what I think we can expect for Zoom. So instead, I try to look at, again, more forward-looking ratios, and also, I'm not doing a comparison this week for Zoom. I guess in theory, we could compare it to Microsoft, but I've done so many comparisons to Microsoft. We could look at Cisco or Adobe, but I really just wanted the emphasis to be on Zoom this week. So we're only going to take a look at their numbers, and this will be, again, a pretty quick section here. So to start, they have an astronomical PE ratio of 152.05 times earnings. Usually that is not a good sign for me, but again, Zoom is one of those companies that have benefited greatly through 2020, so I think that them having a high PE ratio is still semi-justifiable. Now, I did include the price to earnings growth here because I wanted to point something out. If we look at this, at 0.06, that is a very undervalued stock, especially because with the price to earnings growth, remember, if it's below 1, then you can view this as an undervalued stock. But the reason why I wanted to point that out is I think we should all be expecting for Zoom to have a very low price to earnings growth right now, despite them having such a high PE ratio. And that's because price to earnings growth is the price per share divided by the earnings per share growth over time. And as we all know, Zoom had incredible earnings per share growth during 2020. So I don't want people to look at that price to earnings growth and say, oh my gosh, look how undervalued Zoom is. Let's go ahead and buy it. Because I think that there's more that we need to take into consideration than just what happened in 2020. Nonetheless, though, it is still kind of encouraging to see that low price to earnings growth, but that's something that I'm not giving much emphasis towards for this week's numbers. Now, as I previously mentioned, you'll see this week that I am including the revenue growth forward-looking as opposed to the revenue growth year over year. And if you're wondering what forward is, it's essentially just like analyst estimate for their future revenue growth. And still seeing them, after the year that they've had and gaining so much traction so quickly, having a forward-looking revenue growth of 94%, 94.53% to be exact, is very encouraging for me to see, and something that I'm excited about, because I did kind of fear that having Zoom as an investment, with them just really having that video conference, didn't leave much room for them to grow. Now, I'll touch on more of their product line in a second here, but that still was encouraging for me to see that people still have high expectations for Zoom to be able to grow their revenue over the next few years. I was also impressed by their net income margin. 25% sounds pretty low, but in the tech industry, they usually have net income margin of around 17% on average, so 25% is very good for me to see, and it goes to show that Zoom does a good job when it comes to managing their expenses and sustaining their profitability. So for a tech company that was started in 2011, having that quick ratio of 3.6 is something, again, that I like to see, because we don't really see that many tech companies that have that high of a quick ratio in such a short time frame. So from these numbers, there's a few things here that gets me excited. There's a few things here that I think might just be be something to watch out for in the future, but I did do a little bit of a deeper dive into their numbers and analyst estimates through Simply Wall Street to maybe paint the picture a little bit better, and what I found is very encouraging for me. One of the first things that I saw, and I just wanted to show this to you as well, is their assets to liabilities. This is where the quick ratio comes from, but sometimes I feel giving you a visual representation just shows how healthy Zoom is when it comes to their financials. Now, one thing I saw that I really like to see from Zoom, and part of the reason why they are so healthy financially, is Zoom has had no debt in 5 years, so they are a debt-free company. Now, if you saw my video recently about interest rates, you know that that's actually been one of my concerns with some companies, especially newer companies, is if they have a lot of debt, with rising interest rates, it might start to take away from their earnings. So seeing a company that is only about 10 years old and being completely debt-free for the past 5 years gets me excited and gives me more confidence with this company as an investment, knowing that they're not going to be influenced or affected by rising rates. Another thing that took me by surprise though from Zoom is that if you actually look at a discounted cash flow analysis, this is a two-stage free cash flow to equity analysis if you're wondering, they're actually still undervalued as a stock. Now it's only by about $20, so it only gives about $20 worth of runway if you look at it from that perspective, but still, nonetheless, for a company like this to see that they're considered undervalued is something that I like to see, because I thought for sure this would be an overvalued stock right now and wouldn't feel as confident investing in it. But with us still having, even if it is only $20 worth of runway, I'm very excited about that, and it does give me higher hopes for how well this stock could perform inside of a portfolio. Now again, with 2020 being a more one-off year for Zoom, and I don't mean to say that negatively, but we all know that they benefited probably more than even they expected through 2020. So I wanted to hear what management had to say looking forward about their company and what can help drive the growth in the future and what really justifies that forward revenue growth of still over 94%. So I did go ahead and read through their earnings call, and with this being a fiscal year-end earnings call, a lot of this was kind of looking back and talking about the success they had, but there was a few things that I wanted to highlight from this earnings call. They are anticipating for their revenue during fiscal year 2022, which is the fiscal year they just started, to still be around $3.76 billion to $3.78 billion. Which does give them a revenue growth year over year between 42 to 43%. Now you might be wondering though, why is that so much different than the number I just listed? Well, that's their expectations, and the number I previously listed is analyst expectations. A lot of times companies are more conservative when they list their own future growth, and that's because when they miss expectations and it can hurt the company financially, giving guidance is always a little bit of a risky thing. So when you look at it, a lot of times you will see the company's expectations of the future be more conservative of a measurement than what analysts expect. But from what I was able to gather from this earnings call, it sounds like Zoom's biggest driver of growth looking forward is going to be Zoom Phone. Now, I was curious, what's the difference between Zoom and Zoom Phone? Well, Zoom Phone seems to be more emphasized as a business solution, as an all-in-one communication system where you can have your phone calls, video conferences, as well as chat rooms all on one platform. During their earnings call, they did talk about a few customers that are currently using this system, and they've received some very positive feedback about it. Now, this product is only 2 years old so far, but it already has over 1 million users. So that's something that I'm going to be looking at in the future is, will this actually be the biggest driver of growth? Because I don't feel as comfortable investing in a company that is just kind of a one-trick show. If they only had their video conferencing, this probably wouldn't be a stock I'd be talking about right now. But since it looks like they are trying to diversify their business and have ultimately more business solutions, I do like to see that because they're just spreading themselves out a little bit more while still being focused on the communications aspect of their business. And I think that will allow for the future growth as opposed to being something more than just a way for you to see your friends and family while you can't go outside. When it comes to owning Zoom as a stock, it's a company that I actually firmly believe in. I love their management team. I love the way they're run. I think they're a very transparent company. Even when they did have a security breach, they came out immediately and said, this error on our end, we're doing all we can to fix it, instead of trying to brush it under the rug, hide it from the consumers. So that's something that I really enjoy in companies because it's just something that builds trust with me as a consumer. And I think that's always going to be very important, especially in today's day and age, for long-term sustainability as a company. Also, with them being debt-free, that minimizes a lot of risk or apprehension that I felt I would have had going into the stock. But since they have no debt, who cares about rising rates, or who cares if they're over-leveraging themselves? Because we don't have to worry about that at all. They have a strong enough quick ratio too, where if they ever did need to take out debt, which it sounds like they'll never have to, then they can easily get approved for a loan. So this is one of those companies now where very quickly, for a 10-year-old company, I feel is one of those that you can just add and feel comfortable with, kind of similarly to how I've said about Apple, which is Apple's been around a lot longer than Zoom. And if Zoom can keep up this kind of performance in what they did in only 10 years, then looking forward, this can be a great addition to a lot of portfolios. So I did add this one to the Watchlist Wednesday portfolio. I'll get that pulled up so we could take a look at these positions. Quick side note, I took a look at this portfolio yesterday and it was horrible. So fingers crossed today is a little bit better than how it was yesterday. Well, good news is the portfolio is doing better than it was yesterday. Yesterday, we actually dipped below the $5 million. So that meant that we were at a total loss for the starting basis of this portfolio. At least today we've recovered by just shy of around $1,500. So it's at least headed in the right direction. But I have to admit, that was a scare to see because like 2-3 weeks ago, the portfolio was up to like an $18,000 gain. So very volatile times we're in right now, but I think that just emphasizes the point of when you buy a stock, I like the long-term outlook. You don't have to have the long-term outlook, but it just makes me sleep a little better at night knowing if I could just wait it out a little bit longer, maybe the portfolio will turn around for us. Anyway, I bought 17 shares of Zoom yesterday at around $326 a share. Last I saw it was trading at around $351 a share. So not bad, about a $25 gain per share, giving us $420 in profit so far. But this is a stock nowadays I'm buying not with the expectations of this being a 10-bagger overnight like it was in 2020. I think the growth for this company is going to be slow but steady looking forward. But again, this company is so healthy financially that I'm very comfortable with adding this to portfolio, even if it does go through some volatile times. So one I'm excited to have, as I always am, and we'll just have to see how this one plays out. As always, just a few highlights we have here from the portfolio. ChargePoint's making a little bit of a rebound, so is Etsy. Wix is really the big surprise right now, though. I admittedly, as I said before, thought that stock might have been a little risky, but it's proved to actually make us some money so far, so I'm excited about that. Fubo, I just can't wait to get rid of that stock. I can't believe that one's doing so bad, and so is Rocket. I should have seen that one coming too. Pinterest is kind of dragging down the portfolio. Not really. Disney's down too, though. So we have a lot of losers right now, but a lot of these companies I think will turn around relatively quickly, maybe within the next 3 to 4 months. So I'm not too concerned with the current state of this portfolio. And again, this isn't actually my money, so I don't really care about what actually happens to it. But I do like seeing that the stocks I talk about do well. So we'll just have to see how it all plays out. But with all that said, I would really love to hear any comments that you have about Zoom and what your expectations are for this as a company, and if it's something that you're maybe deciding to sell out of, or if you still think that it might have some room to grow and maybe are considering adding more shares to your portfolio. If you like this video, I hope that you consider hitting the like button for us. Remember, 5-cent donation. If you haven't subscribed already, I just ask that you kindly consider doing so. It's a 10-cent donation. Big money there, and it just helps out my channel a lot. I don't ask for it much, but hey, it's worth a shot. We're getting so close to hitting 900 subscribers, which is really crazy to think about. All that said, I'm going to wrap up here though, so thank you so much for taking the time out of your day to watch this. You could be anywhere in the world, but you're right here with me, and I really appreciate that. But I'm going to let you go ahead, enjoy the rest of your day, and I'll see you next time.